the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hello and welcome to the Property Pod, South Africa's premier property investor podcast, right here on Moneyweb. My name is Suren Naidu, Deputy Editor at Moneyweb, and on this weekly podcast and vodcast, we gain insider insights from leading CEOs, analysts, developers and entrepreneurs in South Africa's dynamic real estate sector. This podcast will continue on Iono and other podcasting platforms, but it is a vodcast now, so look out for the video on Moneyweb TV, Moneyweb's YouTube channel soon. Cash Flush JSE-listed real estate investment trust Vukile Property Fund is on a deal-making spree again, it seems, and at the end of last year, it announced buying a 50% stake in Chatsworth Centre from Sanlam. But on the international front is the big money euro deals in Spain. It announced the sale of a retail park in its Spanish subsidiary, Castellana, at the end of Jan for around 279 million euro, which is around 5.2 billion rand. And days later, last week that is, it said it's using part of those funds to buy a dominant regional shopping center in Spain for around 100 million rand. But it's not done. There's more deals in Spain in the pipeline, as well as in South Africa. And who knows, there might be other jurisdictions that the company may look to, especially with its sizable acquisition of London-based Perdera as well. Now, that's a big intro there, but to tell us more and give us deeper insights on these deals, sales, and future plans, we have Group CEO of Vukile Property Fund back on the Property Pod, Laurence Rapp. Laurence, that was a mouthful. I appreciate your time on the podcast, but you and the Vukile team have been very, very busy.
Suren, hi. Thank you very much for inviting me on the show. Yes, we've been exceptionally busy. It's been a wonderful period, and I think still quite a lot more to come. Obviously, what starts getting confusing is all the different currencies that we were exposed to. So maybe just to correct something in your intro, we sold for 279 million euros. But we've deployed 100 million euros, not 100 million rand. So it's been a very busy period, but very happy to walk you through all the various deals and the logic behind them and explain what it is that we're doing.
So, Laurence, what was behind the sale of your Spanish retail parks portfolio? Was it the right time for Vukile? Tell us more about this.
Absolutely. So, Suren, I think most definitely we feel the right time. Just a little bit of history for your listeners and viewers. When we entered Spain in 2017, we bought a portfolio of 9 retail parks, and those were sort of the right entry point for us at the time. The team then got working on those, looking to add value, re-tenanting, perhaps reconfiguring some of the boxes and so on. And obviously we then have followed that up with very significant other deals as well to grow the business to where it is today. But we sort of got to a point now where we feel that we've added a lot of the value to the portfolio. We've grown the net income by nearly 26% over the period since we've owned it. And we felt that as any good asset manager, you've always got to look to rotate assets. So it's not only about raising money and buying new assets, it's about selling existing assets when the time is right and then looking to recycle that money. And we felt that time had come on the retail park portfolio, probably driven by two things. Number one, the feeling that we've sort of, extracted a lot of the value from the portfolio already, and that we felt that money could be better redeployed into shopping centers, which we think are showing higher growth potential than retail parks. But the second issue is that there is a lot of investor appetite for retail parks, which is driving the prices up. But we're also seeing a lot more supply coming to the market of retail parks. Now compare that to shopping centers, where there is virtually no supply coming to the market in Spain, and the yields are relatively higher than what you're seeing in retail parks. So we felt that this is an ideal time, given, call it the maturation of the income stream in the retail parks, together with that strong demand and increased supply, to say, let's actually sell out of the retail park portfolio and redeploy into shopping centers where we're seeing A, higher growth, and B, no new supply coming on into the market. Therefore, we think that gives better growth in rental potential going forward. So that is sort of the background as to why we feel the timing is right for us to do this deal now.
So I gather you got a good price because there was a lot of demand. Were the buyers the only ones you were dealing with, or was it a bit of a bidding war for those assets?
Yeah. So what happened initially is we decided to sell 3 assets and started engaging with some brokers. As a result of that, we got some reverse inquiries on the whole portfolio. And in fact, there were 3 buyers interested in buying the whole portfolio. We went through a discussion with all of them. In the end, we felt that Aries was the right partner for us to sell to. And I use the word partner because part of the deal with them is that we, in fact, are going to continue to manage those centers going forward. So I think, a very strong recognition from Aries as to the Castellana team's expertise and dominance in the market, and therefore wanted us to continue there. So when we look at the deal, we've sold it at book value, in line with external valuations. So I think, yes, we got a fair price for it. It represents a yield of 7.1%, and then that money gets redeployed. But in addition to that, we get the property and asset management fees coming out of it. And that should be worth about 1.2 million euros to us per annum after the costs of running that portfolio. So it actually is a very nice accretive deal in terms of how we redeploy the money, and then also the fact that we get those management fees coming through as well.
Thanks for that insight, Laurence. With regards to the value of the deal, it was around 280 million euro. Since then, literally days later, but I'm sure it was working in parallel, you announced an acquisition of a major mall in Longorongo. I don't know if I'm pronouncing it correctly, in Spain. Tell us more about this deal. Is it in a new area in Spain?
No, the area is called Logroño in La Rioja. It's in the north of Spain. So certainly not a new area. In fact, it's wine country in Spain. And I'll come to the deal, but yes, just to your first point, obviously what we need to do is when one is recycling assets, you've got to make sure that you're not getting cash drag on your earnings. In other words, you don't want to be selling an asset for 7%, putting it in the bank, earning 1 or 2%, and you end up losing the earnings on that. So what's very important for us in the way we do things is to try and time the sale with the purchase. So you can really match your income flows and there's no income dropping off for investors. And that's what we've done. So yes, we have been running not only the Berceo deal, which is the one in Logroño, in parallel with the sale process, but we have got another couple of other deals that we're working on as well. So we're very confident that we're going to be selling the retail park portfolio, which is effective from 1 April. So in other words, we get all the income on that up until the end of March, which is our current financial year. We then get the proceeds coming in on the 1st of April, and that money will be immediately redeployed into the Berceo asset, which is effective from the 1st of February. And then there are 2 other deals that will be in place by then as well. So I think what we've been able to do very well for shareholders is ensure not only that there's no cash drag, but there will actually be earnings accretion from all of this asset rotation work that we are busy with at the moment. So maybe turning a little bit to the asset. The asset is called Berceo. It's in an area called Logroño in the La Rioja region. It's a dominant asset. It completely outtrades its competition and in fact is sort of the dominant shopping center in a 100-kilometer radius of where it is. So it is the key game in town. And that's really what we love to buy. It's got all the big brands. It's got Zara, it's got a Primark, it's got other of the Inditex brand, it's got MediaMarkt, it's got a Carrefour supermarket, which we don't own as part of the center, but it's part of the shopping experience overall. So really it is your one-stop shop for all consumers looking for your ultimate experience. It's an asset that, and you've heard us talk about this before, we're buying from a private equity fund. They tend to be, very good at timing the market in terms of macroeconomics, but they are not necessarily the best at managing the assets. And what we find is that this is an asset that we feel is perhaps been a bit undermanaged, and therefore there's an opportunity for our team to go in and really look to bring our magic and our blend of asset management to, extract more value from the center. And I think, you've been on this journey with us for some time, Suren, so you'll know when we talk about the value we've added to centers like Puerto Europa, Bahia Sur, El Faro, Los Arcos, that the team has got a tremendous track record in adding value to assets, as we're doing on the recently acquired Portuguese assets. So that is where we see the upside in this deal. So number one, we're buying on a yield of 7%. We're using around 40% debt on it. The debt is coming in at around 4.5 to 4.7% all in. So the cash on cash yield after cost is sitting about 8.6%. So you can see very nicely accretive relative to our cost of equity and a very good deployment of capital. But what you'll expect to see over time on this asset is the team adding value to it through, re-tenanting, introducing new tenants. We think there is a lot of scope to bring in new food and beverage, perhaps some entertainment as well. And that all drives greater spend, greater, dwell time in the center. So we're very excited about the prospects and the growth for the center. And also it adds an element of diversification to our income streams, because most of our centers are sort of, in the southeast, southwest of the country. This gives us exposure now in the north. It is one of the wealthier regions in Spain. So you find that GDP per capita is higher in the province than it is elsewhere in the country. So it is a good market for us to be in. So it's a dominant asset, very well tenanted, performs well, but perhaps undermanaged. And that's how we start extracting value going forward.
Since you mentioned the region, I just thought about this question now. I saw in the press release that the area has around 500,000 people. Compared to South Africa, that's pretty low. But you say it's a high income area. And of course, it's Spain. It's a booming economy from the sound of things, not just tourism, but other sectors. Can you share a little bit of insight around that? What's your thought in terms of my comment there?
Sure. Look, I think, it's one thing to look at the catchment area, but it's another thing to look at the income levels. So I think the income levels in the area is around 32,000 euros per capita. Now compare that to South Africa. It's many multiples of the South African GDP per capita. So South Africa is sort of very high volume, low value. There is higher value, lower volume. But I think there are nearly, 6 million visits per annum to the center. So it's, and again, because it's dominant, there is no other real competition in the area for it. There are two centers that are really very, very poor competitors, and the high street is almost non-existent. So if you're living in the area, this is where you're going to come and do your shopping. So you can see sort of multiple, repeat visits from shoppers, and there is, good spending power that's there. So that's why the economy makes sense for us to be there. It's a combination of microeconomic factors and the dominance, which is something that we really value. So I think in property, what's often overlooked are these supply-demand dynamics. Okay, here you've got good demand, good income levels, but you've got very limited supply in terms of anything new coming to the market. So you really have to shop in that shopping center in Paseo, and we think it's going to do great things for us.
Thank you for that. Now, following the purchase, around 108 million euros for that purchase, you have another 170 or more million euros to spend. You talked about further acquisitions. Any insights into that new regions? Is it going to be Spain, or are you also looking at Portugal to spend that money?
So, Suren, all I can say at this stage is that it's in Spain. There are what I'm going to call bolt-on acquisitions. So in other words, it's in our core market, in our backyard. We know and understand the regions, the assets exceptionally well. So very easy to integrate these assets into the portfolio. But I can't at this stage disclose the regions, the assets, the size. We are still busy in those deal processes, but we are quite far advanced in them. So as I said a little bit earlier, what's very key to us is to ensure that we're not having any slippage in terms of income from the proceeds we receive, plus the cash that we have with redeploying that money. So all things being equal, I would like to see the proceeds from the sale of the retail park portfolio plus cash on hand being fully deployed by call it the middle of April.
Okay. Thank you. And obviously, Spain is a huge country and most of your investments are there. The entry into Portugal is relatively new. But turning to a different type of acquisition, the Pradera deal, why property services? And I see it's based out of London. Is the Vukile looking at the London market again and potentially other markets in Europe, especially considering you tried to get capital and regional a few years ago?
So I think don't read too much into the location of the head office of Pradera. They're in London. It's very central. It allows them to sort of manage pan-European quite easily. So let me just give a little bit of the facts about Pradera before we move on to the logic and why we did the deal. Pradera is a business that's been around for 25, 26 years. It is a pan-European asset management, third-party asset management business. Historically, they've managed assets in as far afield as the Middle East and China as well. So tremendous experience in the team and the senior leadership team in particular. They manage today about 5 billion euros of assets for 60 different institutional clients. They operate in 10 countries throughout Europe, including the UK, and they've got a team of 100 people. So now the question is, why did we buy it? And look, it's no secret that we would like to see our business growing further than, South Africa and the Iberian Peninsula. Both of those remain core markets for us, and we continue to look to grow in both of them. But we are also very keen to look at other markets in Europe. Now, as one looks into other markets, you've got to sort of take a number of things into account. Number one is the macroeconomic position, the microstructure of the industry, how you're going to manage the assets, tax efficiency, quality of the assets, etc. But what's most important from our perspective is who's going to manage those assets. And I think where Vukile and Castellana has set itself apart from many other South African REITs that have invested offshore is we've gone there to build a business. We haven't just simply gone there to buy assets and outsource asset management to people. So for us, what's critical, and you've seen it in the success in both Spain and Portugal, is having teams on the ground. So as we've been looking at other markets, the question has been, well, how do we actually build those teams? When the opportunity came up to acquire a stake in Pradera, we saw a phenomenal strategic fit with where we are. So number one, it allows us to look at multiple markets in Europe with a far greater insight and knowledge base into how those markets perform, because we now have teams on the ground that understand the market, understand the local nuances, understand the tenants, perhaps better the lease structures and so on. But perhaps more importantly than that, we've got people. So there are 100 investment professionals that are there. They're a phenomenal team, great expertise, and probably, the biggest reference point that all sort of Vukile followers will pick up very, very quickly is that Alfonso and two of his senior colleagues joined us from Pradera 8 years ago when we started Castellana. So this is not a team or a business that's unknown to us. In a sense, it's the broader family coming back together again. So, everybody who knows Alfonso knows how superbly talented he is. And I think we're going to be getting access to people that are equally talented in their own markets as we look to, at least evaluate and then decide which markets to enter. So really what the Pradera deal has done for us is give us not only the ability to fast track our evaluation of new markets, but it's also de-risked the entry into those markets because we can hopefully enter via assets that have historically been managed by Pradera and have teams that are on the ground and know how to operate locally in those markets. And that should never be underestimated, in the broader property environment. I think we know the challenges some people have had in France with not fully understanding lease structures, labor, etc. I think one doesn't want to make those mistakes. You want to be able to go in there and really know the market as a local. And that's what the Pradera acquisition allows us to do.
Thank you for that. I'm glad you mentioned Alfonso because I've had you a couple of times on the podcast as well as Itu, the South African MD. But I hope to have Alfonso at some stage as well. But there was such a huge amount of different deals. It was only right to have the group CEO on the podcast. So thank you for the opportunity. Laurence, before you go, it's not just about Spain and, Portugal and potentially other markets in the future, but SA is still a pretty big part of your business. I mentioned Chatsworth Centre in December, that acquisition, I think it's a 50% stake. But in the media briefing that you had last week, you talked about potential further acquisitions in South Africa, and you joked that no, Hyde Park is not on the list. So can you share some insights on your acquisition opportunities in South Africa?
Sure. Suren, thank you. I'm very glad that you've mentioned that because, very often we get the question, does your growth offshore mean that you no longer have an appetite for South Africa? And that is completely off the mark. We have a very strong appetite to grow further in South Africa. Our challenge has been finding the right opportunities at the right price to deploy further money. So we've probably spent about 3 billion Rand on the SA portfolio in the last 36 months. And, that is through the acquisition historically, about 18 months ago, I think it is, of BT and Gibbs, which has now been renamed Mall of Mthatha, completely revamped, trading fantastically, and that's been a great turnaround. In December, as you mentioned, we bought 50% of Chatsworth. Hopefully in time, we'll be able to buy the second 50%. And then we have another deal, which is a week or two away from closing in South Africa. And that is another township-based mall that just fits perfectly in our portfolio. And I think sort of really plays to the Vukile strength of sort of looking at township and urban malls and really getting the most out of those. So we have a very strong appetite to keep growing. That's in addition to all the money we've spent on our sustainability strategies, which are doing very well for us and really, being very accretive. So, we have an appetite. If anybody has assets to sell that fit our profile, we'd love to see them. We'd love to talk about them. But there are fewer assets available in South Africa, I guess, because a lot of the owners of shopping centers are themselves institutions and REITs, and they trade assets less frequently than private equity businesses who are largely the sellers in Europe. And that's why we see greater deal flow in Europe than we do locally. But, short answer to your question is we have a very strong appetite for SA. We'd love to grow further here. It's about finding the right assets at the right price that we get accretion and keep very strategically aligned and focused with what we always do.
Laurence, I just thought about it. It would be remiss of me not to ask because the business has grown so much over the last few years. You are top 3 REIT in South Africa in terms of size now. Just in terms of the performance of the market, the REIT sector did very well last year. And I'm not going to ask you expectations per se. Is Vukile still trading at a discount? It was a very topical issue 2-3 years ago after COVID about the massive discounts, but the sector has bounced back quite a bit.
Correct, Suren. We are trading at a bit of a premium to NAV, which is a great place to be in. It gives us a very competitive cost of capital to be able to do deals that are accretive. And, that hopefully keeps growing earnings and driving, share price re-rating along the way. So yes, we're at a premium. But I think, the sector is in a very good space. The macroeconomic position in South Africa is looking a lot healthier than it has been for quite some time. Equally in Spain and Portugal, it's looking very strong. We're starting to see the interest rate cycle turning in our favor. In other words, we expect to see further reductions in interest rates in South Africa. That means that, that's very positive for fixed income investors and any investor looking for a regular income. REITs should most definitely be part of their portfolio. So we still do see further upside, in the share price going forward, driven by a very strong operating environment that we're in. The business is trading exceptionally well. We're seeing very good fundamentals in terms of consumer demand, consumer behavior, especially in the European portfolio. But equally in South Africa, we're seeing a healthy consumer. And I guess, with strong macros, growth in GDP per capita, growth in, PCE spend and lower interest rates, we think that the tailwinds are here to stay for some time. And I think that augurs very well for where REITs are. So if the question really is, have I missed the boat by not getting in yet? Our assessment is that no, there is still certainly upside. Fundamentally, we're all trading very well. Vukile is trading very well, and we'd expect to see further growth going forward in the year ahead.
We'll have to wait and see what happens. Laurence, I'll have to leave it there. Thank you for your time. That was Laurence Rapp, the Group CEO of Vukile Property Fund.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.